I want to move on to cryptocurrencies, which we spoke with your co-author on some of your research on this, Igor Makarov, a while ago. You started looking at crypto, I mean, pretty early in terms of academics who are taking it seriously. What got you interested in studying cryptocurrencies?
So, I mean, to be honest, actually, my students. So what
Mm,
happened is that, so I was also, I've been working in consumer finance and in fintech and financial innovation and venture capital for a long time. And I somehow thought, oh, this crypto thing seems like, this niche. This was like, say, in 2012, 13, right? It was, to me, initially very niche. And I thought, um, kind of, but then and I wasn't sure where it would be going. And to be honest, I was relatively ignorant what it actually was.
mm.
And I was happy in some sense to be ignorant, right? Because then you think that, okay, I don't need to spend so much effort thinking about it. And then actually several of, my students came to me and basically said, look, it's really pathetic that, we are MIT and we don't have a class on the latest things in fintech and in particular not cryptocurrencies. And then I thought, actually, they're right. And at the time, I was group head actually at MIT of the finance department, as a department head. And I tried to convince some of my colleagues to teach this class, and they said no. And then I thought, oh, shoot, now I have to. And so there you go. No, this is like my conflict of interest. So yeah, so basically, kind of. So I thought, I thought, okay, if I need to teach it, I need to really know it, right? And I need to understand what it is. And so that's when I basically started learning much more about crypto. I also, in this class, for example, I invited a bunch of people who at the time were really industry leaders in crypto. For example, the founder of Circle, Alea. At the time, Circle wasn't even a stable coin yet. They were just
Mm.
basically an OTC broker. And we had really good discussions, but also, at that time, there was very little formalized knowledge of what crypto was. And so it was, to me, as a financial economist, I suddenly realized, wow, this is actually a very cool space in the sense that intellectually there's a lot going on, and in a way there's also some reinvention of finance in that space of people who are engineers and don't know so much finance. And then when you are a financial economist, you think like, I have seen this movie and I'm really
Right.
scared. I see it crashing and I can tell all these people that it will crash. And of course, they will not believe me. And then you don't want to say, I
Wow.
told you so. But
Wow.
sadly, some of this actually did happen. Yeah.
Yeah, I've seen a joke about that somewhere about how crypto speed ran all of the lessons from financial economics of the last, whatever, 100 years or something.
Exactly.
So, based on the research that you've done, and I guess the interactions that you've had in that space as well, do you think that cryptocurrencies have been an overall positive innovation?
I know this is a very loaded question. Let me say, and I'm an economist. So I would say there on net, I still feel that cryptocurrencies are still looking for their really big hit application. Um, I wouldn't say the same thing about blockchain. I feel blockchain as a technology for, kind of settlement of trade, maybe for even, kind of settling of international trade contracts and these type of things, has already had and will probably have lots of useful applications. But cryptocurrency, right, as a payment mechanism and as a currency, I feel indeed per se haven't had like a huge breakthrough application yet.
Hmm.
However, I do want to say the following. I feel that the fact that there has been so much talk about our payment system, about the inefficiencies of our payment system, about the pathetic fact that, until recently, it took 3 days for a payment from a US bank to another US bank to settle. I mean, this is just unacceptable in the 21st century, right? So I'm saying all this to say that I think one, at least in the US, very big positive thing that maybe inadvertently came, or maybe intentionally, but came from the crypto discussion is that the US has invested in many new payment realms, right, and rails, and many financial service companies, including the credit card companies and PayPal and Visa and blah, 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 are now starting to think much more how to increase the efficiency, the speed, reduce the prices, and so on. And so I think that on that is very good that this has happened. Now, in a way, it's very sad that it took crypto for this to happen, right? I mean, it's just like, come on, right? The technology was there before crypto, but maybe the regulatory appetite wasn't there, the urgency wasn't there. So I do actually give in a way, the crypto discussions a lot of credit for making people much more aware of the inefficiencies of this system.
So it created some competition for existing payment rails, and even if crypto wasn't ultimately the answer, it just the notion of potential competition made existing payment rails get more efficient.
Yeah,
that's interesting.
I think it also made a lot of consumers suddenly much more aware of what they were paying and not wanting to take it, right?
How does the trading behavior of retail investors in crypto differ from their trading in other asset classes?
Yeah. So I would say there's a lot of interesting research that has started to look at the trading, of people in crypto. And of course, kind of there were people who very early invested in, traded in cryptocurrencies. And there were, kind of also big hedge funds and so on that initially made a lot of money through arbitrage trading. So at that time, right, there was still really big arbitrage opportunities. So you might, this is now ancient history, but there used to be this, what was called the kimchi premium. So the same Bitcoin token was available to buy in South Korea, let's say, for $2,000 more than on US exchanges or on UK exchanges, right? And then, of course, so especially institutional investors started and hedge funds started to arbitrage these price distortions away. But actually, some early retail investors did really well, kind of in these things too. Yeah. Now, I think what over time we see has started happening is that as crypto trading has become, in a way, much more broadly available, there are now many more people, in a way, who trade on it. I would say more for the sake of risk-taking than really doing any arbitrage anymore, right? And there, what at least our research suggests is that in crypto, the average retail investor actually is much more of a buy and hold momentum trader, while in other asset classes, say equity or commodities, right, they are trying to be contrarian. So the last thing I said, right, has been shown not just by us, by actually lots of people who have used data from Robinhood, Charles Schwab, other basically discount brokers. And what you over and over see is that in the more traditional asset classes, retail investors try to be contrarian, and and they basically, what does this mean? That means when the price of an asset has gone up a lot, that's when they typically sell, and when it goes down a lot, they buy in, right? So they must have somehow a belief that the market overshoots all the time, and they know better. And that's why they, want to be contrarian. In fact, there's very nice research by Enriqueta Ravina and and her co-authors at HBS, that shows that this type of contrarian trading in stock is in particular around earnings announcements. So, when there is a positive earnings announcement, the price goes up, retail investors then want to trade against it. Yeah. Now, what we see that those same people who trade this way in their equity and commodities, in crypto, they don't do this. When the price goes up, they keep holding and they don't sell. And when the price goes down, they also actually hold, and they don't either necessarily buy a lot more, but they also don't sell. And so it seems, right, people seem to be much more willing to, in a way, endure the market movements in their crypto trading than in anything else.
What do you think explains it?
Yeah, so we, obviously we just see people's trades. We don't look into their brains. We also didn't have a chance we didn't have a possibility to survey these retail investors. I think, so there is work by, for example, people at Berkeley that have surveyed investors too. We think a lot of it is that the return expectations that people have in cryptocurrencies is different from other asset classes. And what I mean with this is that people somehow have this belief that in cryptocurrencies, when the price goes up, they think it's an indication that the price will keep on going up. And some of it is because maybe, they have behavioral biases and they think, oh, the price can only go up. But it's not all irrational, because if you think about, we are still in the early days of crypto, right? Because we don't, we all don't have a lot of cash flow information, right? Cryptocurrencies don't yet generate a lot of cash flows. So what do you have? You have, you've only the price to update about the future adoption of cryptocurrencies. Yep. And what we think is going on is that what people basically want to figure out is, will crypto become really big, right? It's already growing, but will it become really big? And what model to put on this is very complex. But when they see the price going up, they say, it means that more people are adopting crypto, more people are trading in it. Maybe it also means that regulators will look more favorable on it, that it's not going to collapse. And so, yes, if that's true, then there will be more positive network externalities and the price will keep going up. And so therefore, I think it's actually not irrational if people think that when you see, an increase in the price of crypto, it might also mean that it's there to stay. And therefore, right, the price should be going up a bit.
It's super interesting just that the behavior of people trading in stocks and crypto is different. That alone is just fascinating.
Yeah.
You mentioned earlier being able to bring your financial economist perspective to crypto and see things before they collapse. And you wrote a paper about the Terra Luna collapse. Can you talk about what caused that?
Yeah, what caused that? So what our research suggests is basically that this was a system that was becoming less and less sustainable. And we can go into the details why it wasn't sustainable. Basically there was an anchor protocol, which is that was basically like a money market fund for crypto that was paying out more than 20% in its deposit rate to the people who were depositing funds on this DeFi app, but they were not generating 20%, right, on the tokens, basically on the stablecoin UST. And so then what our research suggests is that over time, a large fraction of the participants in that system started realizing this is not sustainable. And actually that this high deposit rate was being subsidized by some of the investors, the early investors in Terra Luna, and also the insiders who had made a lot of money from the hype in Terra Luna and the fact that the Luna price had gone up so much, right? And so then what we show, looking at blockchain data from the Terra Luna blockchain, is what seems to have been the case, is that there was a trickle of people starting to leave Terra, and I mean also sell UST, the stablecoin that the system had. And then what happened is that a few large investors decided to take, their money off the table, so to speak. And then, kind of there was a run. But, I want to be very careful, because early on, when in the run of Terra Luna, so the co-founders of Terra said that, this was a malicious attack by some outsiders who were trying to destabilize the system. Yeah. Almost like a bank run, right? If you run on a bank that has money invested in illiquid assets that might even be very valuable, right? But if you force them to do a fire sale, then a bank can fail. That is even a solvent bank, right? This is why banking is so difficult. That's why we have the Fed and so much regulation of the banking system and so on, right? But what our research shows is that that doesn't seem to have been the case of Terra Luna. The problem of Terra Luna was basically that there was no seriously productive asset that they were investing in. And with time, more and more people realized, wow, this has to come to an end. And so then it was more a question of who will let the first, shoe drop, in a way, right?
Wow.
Rather than this being a malicious attack. And then what we basically show in the research is that ultimately it was large investors that ran first, realizing, right, now this thing really is going down. And unfortunately, the small and poorer investors were the ones who didn't realize that even a run was already starting. So they kept buying. In fact, they even kept buying from the big guys who were running from the system. And they only ran much later, when the price had already, collapsed quite a bit. And so they lost way more money.
Wow. So big informational asymmetries that affected the smaller depositors.
Exactly, right? And the sad thing is, of course, that one of the promises of the open, permissionless blockchain initially was that everyone, even small people, can see what's going on the system, right? But exactly as you just said, Ben, just having the data is not knowledge, right? You have to have the model to understand what is going on. Is it a run? Is it not a run? In fact, I saw on many, kind of crypto Twitter and the chat rooms of Luna and Anchor during the run on Terra Luna, some people were saying, "Oh, now is the time to buy the dip." So you see, they didn't even understand this was a run. They thought just like, "Oh, now is a good time to buy into it." But that really shows you that they really didn't understand the underlying system that was being created.
Crazy. You'd have to think also that with a project like that, the depositor base would be relatively undiversified just by nature of it being a crypto project, which is like banking risk management 101 to not have a concentrated depositor base.
Absolutely. And, I mean, in particular, I think in Asia, in particular in South Korea, a lot of people lost a lot of money because Terra Luna because the founders originally are from South Korea, they marketed it more strongly there. And so from everything, what we studied, there actually the welfare impact on many retail investors really was very horrible.
Yeah, that's terrible. What do you think the outcome of this thing suggests about the role of regulation and maybe even central banks in the financial system?
Yeah. You see, in the end, right, there is, unfortunately, you can say, but unfortunately, financial markets will always have risk. And in particular, banking has a lot of risk because there are, as we were just saying before, right? Banks inherently, if they do maturity transformation, meaning, they invest in long assets, but give you deposits that you can withdraw whenever you want, they are inherently somewhat fragile. And that's why we have a regulatory system like, kind of the central banks, a lender of last resort, a deposit insurance like the FDIC, right? To assure people that they don't need to run when they hear a crazy rumor, right? If it is a regulated bank. So in a way, there is a reason why all these things are in place. And they do protect, in particular, retail investors who, in particular, right? I mean, if you think about it, people don't have time to watch their money 24/7, right? They have real lives to live. They have work where they have a schedule, right? You have to be very wealthy to just be looking at your money, to be very honest, right? And so I think what we have basically seen in crypto is that ultimately all these truth, right, that people have been studied, and in a way these repeated things that occur in financial markets also occur in crypto. And just the fact that something is on a blockchain or that it's outside the regulatory framework actually doesn't make it somehow better. It doesn't make it it does not even make it more competitive. That's, I think, the shocking thing that many people don't understand. I hear this all the time, from people who are in crypto, that they say, but look, the one big difference is because it's an open system, it's a permissionless system, anyone can access it, therefore it is more competitive. But that's not true. And the reason it's not true is because financial services by their nature have massive economies of scale and scope, and they have network externalities. And so what does this mean, right? What it means is that when you big begets more big in finance. Liquidity, if you think about it, is the ultimate network externality, right? It's basically when you are a big market, even if you charge people a lot, traders will come to you because execution is best in the liquid market. And basically, and that's why if you look even in cryptocurrency, I mean, in the crypto world, right, it's Uniswap, right, is still the biggest, decentralized exchange, even though there have been many startups like SushiSwap and other, and many others. But you can see that without any regulatory intervention, naturally, that system actually became very centralized. And it's exactly because of, in a way, the natural law of finance that economies of scale, scope, size are working. But think about the following, right? When there is no regulation possible, once a provider becomes very big, nobody is telling Uniswap, look, your fees should not exceed XYZ. And in particular, it shouldn't exceed XYZ for really small people who don't really know what they're doing, right? So then actually what you saw, right? You were exactly saying this before, really in a massive fast forward, how a system that was meant to be competitive itself made itself very uncompetitive. And we see this in many of these financial applications in the crypto world.
Oh, yeah, so interesting. I mean, it happens in finance. It also happens in technology, where decentralized technologies tend to centralize, and crypto is kind of getting that from both sides, from the technology side and the finance side.
Absolutely.